A warm good morning to one and all present here. Respected Antony Joseph sir, the resource person of today's webinar, respected participants, dear colleagues, and my dear. This is an era of webinars. Such a programs offers us a good opportunity to enrich our knowledge on various subjects by being at our convenient locations. Today we are also in a virtual platform to know more about the topic behavioral finance. As you know, this is one of the emerging topic in the field of finance. To my understanding, it is basically the adaptation of human factors as well as the application of psychology in theoretical and empirical research in finance. Today we are having an eminent personality with us who is guiding many research works in this field. It is none other than our dear Antony Joseph sir. Let me also proudly mention that he is my professor at SB College Changanasheri. He is always a well-wisher to our department also. I wholeheartedly welcome you, sir, to this webinar.
Thank you.
Next, I would like to welcome all the participants, including the faculty from various colleges, research scholars, PG students, and participants from various fields of commerce and business. Let me extend a warm welcome to you also. Let me also welcome all my dear colleagues and dear students who work behind this center. Once again, welcoming you all. Thank you.
Okay.
Over to you, sir.
Okay, thank you. Hello, my dear friends. First of all, I would like to thank St. Aloysius College, Edathua, and the Department of Commerce of that college. I had been reading and doing some research works in this field for some time. I got the opportunity to read some standard books and very popular and well thought out research articles published by the pioneers in this field. But at the outset, at the beginning of this program, I would like to tell you that I am not an expert in this field. Not at all an expert in this field. I have some reading in this field. I have some works related to behavioral finance. That's why I have accepted the invitation of the Department of Commerce, St. Aloysius College, Edathua. We know that behavioral finance is actually an emerging field, but not a new field. And we haven't actually incorporated behavioral finance in the curriculum of UG or PG in our university. But during the last syllabus revision, we got an opportunity to incorporate this particular topic with the blessings of some teachers, especially the contributions of some young teachers of the different colleges in Mahatma Gandhi University helped us to incorporate this particular topic into the curriculum of MCOM, whatever it be. I would like to introduce something about behavioral finance. But the time available for me for introducing this wide topic is just 1.5 hours. So I would like to tell some important factors, some basic aspects regarding the behavioral finance. So first of all, I would like to tell you what is this behavioral finance. Actually, behavioral finance refers to the application of psychology to the financial management or the personal finance arena. The principles of psychology are being incorporated with the theories of finance we have learned. The behavioral finance actually believes that the financial decisions of individuals are influenced by their emotions, their beliefs, their perceptions, their personality, and many other factors. This is very, very important. The behavioral finance actually accept that, or it argue that whenever individuals are taking decisions, all the decisions, especially the financial decisions, all the decisions are being influenced by their emotions, their beliefs, their feelings, perceptions, personality, and many other things. My dear friends, I would like to tell you one example from my own life. 2 weeks back, I have visited a shop for booking a car. After or by the end of the discussion with the executive there, he asked me, is there any exchange? That is, are you exchanging your old car with the new one? Actually, I was accompanied by my wife and my 2 kids. Whenever the question is raised by the executive, immediately my children and my wife answer to the question, no, no exchange. That means we are not ready to sell our old car at the time of buying a new one. You people should remember that I had been using this car for the last 14 years, 14 years. It's a small car, a Wagoner, used by my family for the last 14 years. When there is a good offer for that car by the car company, the family as a whole rejected the proposal. We want to retain that car. That's also a financial decision. Actually, our emotions, our feelings influenced our decision. I have actually traveled in that car for more than 160,000 kilometers. For the last 14 years, I had been using that car. even though that this is a small car, we have enjoyed it. My family enjoyed the traveling in that car. So we have some sort of emotional attachment with that car. I would like to tell you that these kinds of emotions are actually influencing the personal financial decisions or the individual financial decisions. So take another case. Suppose if you have a small piece of land with a small house, which is given by your parents to you, how many of you will be ready to sell it immediately? Even if there is a good offer for that car, that particular piece of land and building, many of you will think twice whether or not to sell, because there is some sort of emotional attachment with that particular piece of land and the building, because it is being given by your loving parents. Of course, definitely there may be some people who may not bother about such things, but majority of my listeners uh, may not be ready to sell a piece of land and a small house given to you, small or big, whatever it be, given to you immediately because of your perceptions, your personality, your beliefs, and more than that, your emotions related to that house and your relationship with your parents. Okay, whenever we take some financial decisions, our beliefs, our emotions, our feelings, our perceptions about the things around us definitely will influence our decisions. That's what the behavioral finance authorities says. Now there arises a question, sir, is this a new piece of information? Is this a new piece of information? We are familiar with this. Definitely we are familiar with all this. But you remember, we have already studied a number of theories related to finance and financial management, related to capital market, related to personal investment, and so on. I hope almost all of you have studied financial management as a subject in UG or PG. You may have studied the portfolio analysis, then so many other advanced topics in investment and capital market. You simply rewind. What are the theories you have learned? And what are the assumptions there? What those theories were actually telling us? Our teachers taught us so many theories. For example, take the case of Modigliani Miller's theory or the random walk theory in capital market. You have learned a lot of theories, and you simply rewind what we have learned. Whether these theories are actually taking into account our emotions, our beliefs, our perceptions, or uh, the errors we are used to commit while taking decisions, these are actually not taken into account by the theories we have learned. So there is a contradiction between the finance we have learned and the new behavioral finance. The new behavioral finance. The financial management theories, the portfolio management theories, the theories related with derivatives, all these are, we group them under the category fundamental analysis. Fundamental analysis. Oh, sorry, the standard finance. Sorry, all of them, the financial management theories, the capital market theories, the portfolio theories, the derivative theories, all those theories were categorized into standard finance. And now we have behavioral finance. So arises the question, what is this standard finance and what kind of difference is between standard finance and the behavioral finance. Let us discuss a quote, or let us see a quote by Mir Statman, a professor. People in standard finance are rational. He says, people in standard finance are rational. People in behavioral finance are normal. This is a quoting by Mir Statman, who has done a lot of work in the behavioral finance, who taught behavioral finance in reputed universities. So we have to see what he has said. What is the inner meaning of this quote? The first sentence is very important. People in finance, of the standard finance, are rational. That is the most important thing. While studying the theories of financial management, the modern theories of portfolio management, and the theories of option pricing, wherever you go, whatever you have studied, all those theories were actually based on the assumption that the investors are rational. That means the theories, basically the theories coming under standard finance were actually based on the assumption that human beings are perfectly rational. Human beings are perfectly rational. Human beings are actually taking decisions, and they are rational. Their choices, their decisions will be based on their rationality. That means a person who tries to maximize his profit from a transaction, or from all transactions he is engaged with, is technically known as a rational person. That means the standard finance theories never considered the effects of human emotions and the cognitive errors of financial decisions of individuals. Once again, I would like to repeat, the standard theories, whatever theory we have learned, all those theories were never considered the effects of human emotions. The cognitive errors which are to be committed by the decision makers while taking decisions, we haven't considered. We simply assumed that people are rational. When people are rational, there is no chance for considering the emotions. The level of intelligence is assumed to be equal. He is not expected to commit any error while taking decisions. The personality, the difference in personality is need not be considered. So all the theories, all the conventional financial management and portfolio theories are built on the premise that the individuals taking decision are actually rational, perfectly rational. But the behavioral finance is developed on the fact that, on the pillar that the decisions are being influenced by the emotions, the psychological factors, the perceptions. All these can influence the decisions of human beings. Actually, the standard finance is a body of knowledge built on the pillars of the arbitrary principles propounded by Modigliani and Miller. One, the arbitrary principle. You have studied theories with respect to the capital structure and the dividend policy. That is what I have mentioned, arbitrary principle propounded by Modigliani and Miller. And the portfolio principles propounded by Markowitz. The capital asset pricing theory or capital asset pricing model propounded by Sharp, Linder, and Black, option pricing theory propounded by Black, Scholes, and Merton. These are actually considered to be the pillars or the foundation stones of the standard finance theory. Many of us have already learned these theories. All these theories actually is built on the premise that the individuals or the investors are really irrational. But we know, we are trying to know that how far the people are rational, to what extent people are rational. The core of the standard finance, I have already told, the core of the standard finance is that the assumption that people are actually rational. Coming to the standard application, we can see a notion that is Homo economicus. Homo economicus, it states that, or in other words, this is referred to as a rational man model. This Homo economicus assumes that human beings are completely rational. So their actions are motivated by maximization of profit. What is the goal of a particular action? If a human being is rational, when an action involving finance is motivated by maximizing or maximization of profit. We have studied about efficient market. I don't want to elaborate what is an efficient market. Under the standard finance, we believe that the market is efficient. That is, the market is efficient to incorporate all information available. All information available. Market is efficient to incorporate all information available, and the prices prevailing in the market is the intrinsic value of the share of the company which we are actually referring. But there is a shift from efficient market to irrational markets. The markets are irrational. Some difference. If you look at the movement of Sensex or the Nifty, Sensex actually touched 50,000 recently. In this COVID era, Sensex touched 50,000. It is slightly lower than that. But even then, you have to see why. What is the reality? What is the reason behind that? The people who are dealing with economics are actually completely worried about this. While conducting while evaluating the fundamental aspects of the economy of the country, we are of our country, as well as the major economies of the globe. All the countries are actually showing, almost all countries are showing a negative growth. Growth is there, but the growth is actually negative. At a time when the GDP of countries are growing at a slowest pace, the Sensex is going up and up, or the capital market indices of major economies are going up. What is the logic behind this? Is it actually rational? The Reserve Bank of India recently published a notification cautioning investors there is a possibility for a downward trend in the market. The investors should be very careful. The investors should be very careful because whatever seen in the current market is not rational. It is not possible to estimate or to expect an upward trend in the capital market when the economy is in a rolling situation. It is falling down. Whatever be the industry you are looking at, almost all industries are performing not up to the expectations. But even then, the capital market is going up. That itself is an indication that the market is not efficient. That means the markets are now tend to be irrational. That is a basic argument of the behavioral finance experts. Okay, we have seen, actually, we have already studied about efficient market. Efficient market hypothesis actually is emerged from the contributions of Eugene Fama. It's emerged from the PhD thesis of Eugene Fama. That's the quality of a PhD. Okay. In efficient market, we believe that all investors are well informed. The investments are appropriately priced. Prices of the securities will reflect all available information. Prices of a security at any point of time will match with its intrinsic value. These are actually the basic principles or basic assumptions of efficient market hypothesis. Now we have to check all these, whether these arguments are right or not. What Eugene Fama said. We say that, or Fama says that all informers are well informed. That means investors know almost everything regarding all alternative investments. Investors have the access to information regarding all investment avenues. You simply think about it. Is it possible? How many of you are making investment in securities market? And you simply think how many shares you know. If you consult with a person who had been investing in capital market, who may or may not be educated, he may tell you a large number of shares which you may not be knowing. I have too many experiences. That means there is very, very little chance for investors to know everything regarding all investment avenues. That means the fundamental assumption of the efficient market hypothesis is not at all valid. That is the argument of behavioral finance experts. And another important thing is that we have already told you there is a fundamental assumption, that is investors are rational, and the prices reflect all available information. That means that itself is an indication of rationality. Prices reflect all available information means whatever be the price of a particular security in the market. That should be based on the available information. That is, positive news or positive information may lead to an increase in the price of the security, and negative news can influence negatively to the price of that particular security. But here, the information alone is taken into account. The emotional feelings of the investor, the cognitive errors that may be committed by the investors are not at all considered in deciding the intrinsic value of the security. That is the argument. That is the most important criticism leveled against the efficient market hypothesis. We strongly say that if these are the fundamental assumptions of the efficient market hypothesis, no market can be considered as efficient. No market can operate like an efficient market. There is no efficient market. Not even a single market is actually incorporating all information. Not even a single very few investors are rational. The level of rationality of the individual investors differs. The types of errors that may be committed by the investors differs. So these are not taken into account while framing the efficient market hypothesis by Eugene Fama. That's a very important criticism. Oh, you may wonder why I'm talking about efficient market hypothesis, because we have learned it. But we are building our theory on the limitations of the existing theories. Why we need behavioral theory? Why we need behavioral theories? Because the modern theories of finance are not 100% true. They are actually based on something which are not believable. Okay, we have to see a rational economic man and behaviorally biased man. Okay, I have already told you Homo economicus, otherwise a rational economic man. Now we are proposing human beings are behaviorally biased men and women. Correction. Okay, human beings are actually considered as rational. The argument of Homo economicus school or rational economic man model is being criticized on the basis of three important principles propounded by the rational economic man model. The first one is the principles of perfect self-interest. Perfect self-interest. This is being criticized by many researchers. Many studies have shown that people are actually not perfectly self-interested. The meaning of that term is actually non-ego. Self-interest, interested in one's own affairs only. You think about yourself. Are you interested only in your affairs or only in your affairs? If people are perfectly self-interested or interested in own affairs, then what is the possibility of charity? What is the possibility of philanthropy? What is the possibility of caring someone who you do not know? Suppose if somebody comes to your home for a help, will you be ready to help? Many of my listeners definitely will do that. If you find somebody is met with an accident in a road, definitely large majority of the people will definitely respond to that, will try their level best to provide some support. So for example, if a young boy is met with a small motorbike accident, if you find that, I know you people definitely will try to give him some sort of help. That shows you are not completely self-centered. And another thing is the principle of perfect rationality. Perfect rationality, when human beings are rational, they have the ability to reason and make beneficial judgments. When human beings are rational, they have the ability to reason and to make beneficial judgments. They will take decisions with the intention of maximizing profit. The benefits are to be maximized. But you know that in many cases, the profit maximization may not be the main driver. Your decisions will be influenced by the impulses such as fear, love, hate, pleasure, and so on. When you are completely rational, my dear friends, when you are completely rational, your objective will be profit maximization alone, and your decisions will not be affected by the uh, uh, impulses like subjective impulses like uh, fear, love, affection, and so on. You will not bother about those things. Now you know that this perfect rationality is not prevailing, or it is prevailing only in case of very few people. Individuals are not perfectly rational because their decisions are being influenced by their emotions. And another thing is the principle of perfect inspection. Sorry, perfect information. That's a mistake. The principle of perfect information, not infection, perfect information. We have already seen in the financial management theories and in the modern capital market theories, the individuals have, or the individual investors, or the people who are taking decision are having perfect information. I have already told you, is this possible? You ask yourself, how many securities you know? How many securities listed in the Bombay Stock Exchange you are familiar with? You simply test your memory, write down the number of shares you know. You cannot make a very long list. And you, different people will make different lists. That's a simple test of perfect information. And do you know exactly how many companies are expanding their operations? And more vital information, how many of you know how many companies are being faced the threat of liquidation in India? A large number of companies are facing the threat of liquidation The debenture holders and the financing companies have filed insolvency petition with national company tribunals under the insolvency procedure code. Do you know exactly what all companies are faced by this trouble? No, I don't know exactly. It is actually not possible for everyone to know every piece of information regarding the securities or the companies or any other investment avenue. Even we don't know exactly who all are issuing bonds in our country. What is the current rate of bond? How many tax-free bonds are being issued by different agencies? We don't know exactly. So these are the principles upon which the rational economic man model is built. And we say that these principles are actually not working, not perfectly working. So we claim that people are neither perfectly rational nor perfectly irrational. That means in between, people are in between. People are neither perfectly rational nor perfectly irrational. Means to a certain extent, people are rational, to other extent, they are irrational. And the decisions are being influenced by so many things. Not only the financial considerations, not only the profit consideration, not only the wealth maximization consideration, so many other factors, human factors are being are influencing the decision making by people. Okay, since uh, the economic man model is not applicable, experts in the field of decision making theory came up with another theory which is very popularly known as bounded rationality theory. You might have heard about bounded rationality theory. It's a very simple theory. This theory assumes that individuals' choices are rational, but they are subject to limitations of knowledge and their cognitive capacity. It's very important, my dear friends. Bounded rationality theory says that always individuals' choices are actually rational. Whatever be the choice, to a certain extent, it is rational. But this rationality is being subject to the knowledge of the person who is taking decision and the cognitive capacity of that person. These are very, very important. You know that the knowledge level actually differs, and the cognitive capacity of each individual differs. So the level of rationality also differs. That's why we say that people are neither completely rational nor completely irrational. Okay, you imagine you have a piece of land which is offered for sale. You put a notice, this land is for sale, contact. Suppose if you are rational, how will you take a decision, final decision to sell? That is, at what price the land can be sold? If you are rational, you will sell only when there is an offer which is equivalent to the maximum possible price, which is equivalent to the maximum possible price. So arise a question, how much will be the maximum possible price? Whenever we speak about maximum possible price of a particular commodity or a particular thing, say for example, specific example, maximum possible price of the land, the price differs according to time. You know that. Price at different time periods will be different. So how will you take a decision? The quoted price, the price quoted by a particular proposer is the maximum. For that, you need complete information regarding the probable prices at different time periods. That is the price that may be realized at present, after 1 month, 3 months, 6 months, 1 year, 2 years, 5 years, and so on. You should have information regarding everything. Then only you can take a decision. Is it possible to take such a decision? It is practically not possible. You will sell, or you will be ready to sell the product whenever the price quoted matches with your expectations. And your expectations will be influenced by your thoughts, your knowledge base, and your cognitive capacity. So the rationality of individuals is bounded. It has a limit. We take a decision when something or the outcome of the decision satisfy our demand. That may not be the best decision, that may not give the maximum return, but you will finalize or you will take a decision when the outcome of the decision satisfies you. That's why we call it as bounded rationality. My humble request is to search in the web for bounded rationality. The original article is available. You try to read. I have tried to read the original article of bounded rationality, and I believe I have learned 25% of what the author said by taking more than 2 weeks time. I have spent more than 2 weeks to understand not only this, the original theory. Original theory is actually mathematical oriented theory. I'm not so familiar with the mathematics. I have learned the derivations with the help of my children. I was not even able to read the notations given in the equations. You have to take pain for reading standard articles. If some teachers who are actually planning to teach behavioral finance in MCOM, my humble request is to read fundamental theories dealing with the behavioral finance. You have to learn. You please don't read any small textbooks which actually give you some samples. You have to read or you have to understand from the original authors. That will definitely give you the original wisdom. It will take some time. It will be painful, but even then, you will become an expert in this field. Definitely, anybody can be an expert in this field. You can do a lot of research in this field. Research opportunities are there. Some of my students are doing research in this field. Okay, you can uh, teach this subject with passion if you can study the theories, underlying theories with a passion. Okay, now we have to speak something about the modern behavioral finance. I have already told you behavioral finance is actually a branch of finance which actually incorporates the daily financial decision making issues. This is actually related to decision making theory, which incorporate daily decision making theories takes into account the human affairs or the human aspects or the human emotions and beliefs. We have to see the contributions of the economists. My dear friends, all my dear friends from the field of commerce and business management, you duly recognize the contributions of economists to the subject of commerce and finance. Actually, finance is coming under economics. It's a branch of economics. And we have borrowed that. So if you want to learn the finance uh, from the root of the subject, you have to learn economics. That's why I have told you. That's why I'm presenting some important people, experts in the field of economics. So first of all, I would like to speak about Adam Smith. I don't want to speak so much about him. You know exactly Adam Smith and his most important contribution, Wealth of Nations. Adam Smith is the first one, to the best of my knowledge, who proposed or who argued that human beings are not completely rational and their decisions are being influenced by the moral sentiments. He has published a book in 1759 titled The Theory of Moral Sentiments. The theory, that book actually very specifically, very clearly says that the human decisions are being influenced by so many things other than profit maximization. Even though Adam Smith belongs to classical economics, at that age, he has identified this particular phenomenon. That's why I have told you uh, the concept of behavioral finance is not new. And another important person, Jeremy Bentham, he has published a very famous article dealing with psychological aspects of economic utility. Psychological aspects of economic utility. He has specialized in the field of decision theory, contributed a lot, said that the conventional utility theory is not right. And he said, happiness, A subjective experience is the ultimate human concern. You think and try to see whether this is right or wrong. Happiness, the subjective experience. Happiness is a subjective experience. Something may make happy. That may not be you may not be happy with that, but I will be happy with a particular thing with which you may not be happy. That's why happiness is a subjective experience, which is the ultimate human concern. That means whatever be the decision, whether it is financial decision or non-financial decision, whatever be the decision, the ultimate objective is the happiness of the person who is taking decision. The happiness is, or the mental satisfaction, in other words, the mental satisfaction may be the ultimate objective or ultimate human concern, and people are trying for that and not for maximizing the profit or maximizing the wealth. Suppose if maximizing the wealth gives you the maximum happiness, definitely you will be irrational. You will take decisions on that basis, but all people are not similar. Some people, the reasons for happiness differs from people to people, or from person to person, from groups to groups, and so on. So you remember, happiness or the mental satisfaction is more important. That's what the modern behavioral finance is trying to say. Okay. Some other important economists: Louis Leon Thurston, Frederick Mosteller, and Phil Nogi. These a team of economic researchers, they have actually tested the expected utility theory. My dear friends, if you want to know more about behavioral finance, you have to learn the conventional expected utility theory proposed by economists, and then you have to look at the modified expected utility theory by modern economists. Then you can understand exactly what change the economists are actually proposing. Okay, they have tested expected utility theory. Expected utility theory was a well-established theory in economics, but some researchers have actually uh, conducted experiments in that field, conducted a large number of research in that field, and they have proposed new models, identified something new which is not stated in, or which is in contradiction with the conventional expected utility theory. And another very important person, Maurice Allais, a Nobel laureate in economics. He has actually showed that, he has proved that, or argued that expected utility theory did not apply to realistic decisions under risk and uncertainty. He has studied about risk and uncertainty, and he proved that this theory uh, cannot be applied to realistic decisions under risk and uncertainty. And in connection with that, he coined the term Allais paradox. I don't have much time to explain all these. That's why I'm skipping. If you want, if you have time in subsequent presentations, I'll be able to explain to you all these types of things. Allais paradox is also a contribution by Maurice Allais. Maurice Allais is a Nobel laureate. He has contributed a lot to the theory of economics, especially to the decision theory. And now we have to see only some early contributors to behavioral finance. Howard Raifa. He has published an article titled Decision Analysis, Choices Under Risk and Uncertainty. And Another very important team, Amos Tversky and Daniel Kahneman, actually, Tversky and Kahneman, they have contributed a lot to the development of behavioral economics and behavioral finance. Both of them were actually psychologists. Their contributions include judgment under uncertainty, heuristics, and biases. Then another is the prospect theory. Then another one is aspects of investor psychology, emotions, preferences, and biases investment advisors should know about. Why I am telling you these titles? Because I don't have time to explain all these. You have to learn exactly what all these. When I say this is an article, you try your level best to get this article and read it. If you read an article by Amos Tversky and Daniel Kahneman, it will be beneficial for you because you are reading or you are understanding from the founder of this particular subject. When you are reading from some other people, you will be reading what the authors understood from the articles published by these people. Sometimes many authors are actually not watching or not they may not have seen these articles or books. Even then they may write simply by taking information from different sources. That is not the right way of learning, especially for teachers. Okay, if you are in need of some articles, please tell me. Definitely, uh, I will support you if it is available with me. I have a collection of good articles. If you are in need, I can support you to the extent possible. Now, I have only 10 to 15 minutes for presentation, so I would like to tell you some uh, important investor bias. Okay, with that, I will be able to conclude. Okay, the first thing is what is actually investor bias? Investor bias simply refers to the mistakes committed by individuals or the investors while taking decision. There are different varieties of bias, different varieties of uh, mistakes which are actually committed by people. And these bias may be cognitive or emotional. So first of all, I would like to tell you about overconfidence bias. It's a very common bias. Only thing is to link this bias with the decision making of investors. Okay, whenever we see that, whenever a person failed in a particular aspect, say for example, a good batsman, by his body language, you may feel that he will perform better in today's match. Suppose if he fails, if he is bowled by the bowler, definitely some people will say it's overconfidence. When a when a smart student doing problems uh, immediately commit a mistake, a simple mistake, you as a teacher may say it's due to your overconfidence. Be careful. So we are familiar with the concept of overconfidence. Overconfidence simply refers to the unwarranted faith in the reasoning, judgment, and cognitive abilities of a person. Suppose if I believe that I know which the price of which share will go up today more than 10%. If I say so, that's an indication of overconfidence. How can I say? How can I say that the price of a particular share will go up by 10%? It is practically not possible. It is only a guesswork, and I think that it will happen. If I strongly believe that what I predict will happen, that's an indication of overconfidence. A large number of studies are there prove that investors are overconfident in their investing abilities. Investors are overconfident in their investing abilities. That means the investors believe that they have more capacity in taking decision than they originally have. Okay. When a particular investor is actually overconfident, he definitely will believe that he will be able to predict the price movements with precision. So, my dear friends, if you can study about this overconfidence bias with special reference to the capital market movements, you can ask a question like this: what is your expectation regarding the fluctuation in the price of a particular security? Say, for example, in case of ICICI Bank Limited, the share of ICICI Bank Limited. You ask a question, what is your expectation regarding the increase in the price of the shares of ICICI Bank? And you give different options. As in the case of a questionnaire, you give different options. Up to 5%, 5 to 15%, or 5 to 10%, 10 to 15%, and so on. Generally, overconfident people will mark an option which is not normal. That means which is they expect a high increase in the price. If the level of overconfidence is comparatively less, they will stick on with the least bracket. Okay, so many people have studied about the overconfidence. The major findings of overconfidence, the study in this field is confident investors overestimate their ability to evaluate a company as a potential investment. Overconfident investors generally overestimate their ability to evaluate a company as a potential. Their ability for evaluation is overestimated. In reality, they may not have the capacity to evaluate the performance of a company, but they believe that without having the original quality, original capacity, the investor believes he can. That's an indication of overconfidence. And another indication is overconfident investors trade excessively. Trade excessively. They believe that they possess knowledge. They possess skills for assessing the performance of different securities. So naturally, they will trade more frequently. So that's another indication of overconfidence. If an investor is not so overconfident, he or she will stick on with the investment for a long period of time, normally. On the other hand, if investor is having on overconfidence or faced with the trouble of overconfidence, he will repeat the process of sell and buy, or more volume of transactions will be there from the part of an overconfident investor. Definitely, you know that. The studies very specifically shown that people or the investors who make excessive volume of transactions, that is frequent buying and selling in the market, will not give better return than long-term holding of securities. That is proven. So many studies are there. But overconfident people will not accept with this, and they will trade very frequently and commit losses. And overconfident investors generally will not bother about the historical track record of the performance of different companies or different stocks in the market. But they believe that they have clear idea about it. They may not have gone through the statistics regarding the price movements of securities, but they feel that they know it. When you know it, what is the reason? What is the need for spending time? That will be the attitude of an overconfident investor. And an overconfident investor hold undiversified portfolio. Undiversified portfolio. That means the portfolio built by an overconfident investor will consist of minimum number of securities. He will not go for a large number of securities. We know that the portfolio theory says that the number of securities in the portfolio is larger, the risk will be less. But the overconfident investor will build up a portfolio with a minimum number of securities with which he expects. He believes that he know everything regarding the securities he or she is actually selecting. Okay, then what is the need for building a large portfolio with a number of securities? No need for that. If I am able to make profit from a very few securities, what is the need for searching and identifying good securities from outside my list? There is no need for that. That is the feeling, or that is the belief of an overconfident investor. That's actually a wrong notion. Overconfident investors definitely will end up with heavy losses, you remember. And there are studies showing that men are actually showing more overconfidence than female. And you remember, so in connection with this, there are several studies. Men are committing or incurring more losses than women. So there is a connection between gender and this overconfidence. These are the areas where we can conduct study. Okay. Another bias I would like to explain is anchoring and adjustment bias. Anchoring and adjustment bias. Okay, anchoring is, say for example, when you want to estimate a number regarding the profit of a particular company, which is actually not known to you. The profit of a company is not known to you, but somebody asks you to estimate how much will be. There is a general tendency that you and me or the human beings will put up a number which is considered as an anchor. You fix something which you do not know. You put a number for something, maybe for profit, maybe the price of a particular share, maybe the census and so on. You put that. And in future, with additional information, you will be modifying this number on the basis of the anchor. Actually, anchoring and adjustment is a psychological heuristic that influences the way people actually estimate the probabilities. Once again, I would like to tell you, anchoring and adjustment is a psychological heuristic or mistake that influences the way people actually fix the probabilities or assume probabilities. Actually, people or investors inhibiting or having this kind of bias are influenced by some points or some level which is in their mind. According to their estimation, a point is there or a level is there. So, for example, regarding the price of a particular share, so for example, you believe it is 210, then your decisions will be, or your future decision making will be based on that particular level. You may not know exactly what is happening or what is the reality. You stick on with a particular thing. Okay. Okay, when so many studies are being conducted with respect to this particular uh, bias, and it is found that investors actually tend to make general market forecasts that are very close to current levels. So, for example, if I ask you to say something about the Sensex for the next month, that is after the budget, how much will be the Sensex by the beginning of April? On what basis you will make a judgment? The basis of judgment will be the current index. So, for example, if the current index is around 39,000, you will make a number in accordance with or making some adjustments to this 39,000. You will not consider the realities. So many things may happen before the 1st April or before the first week of April in India. The budget is expected to come, and more reports regarding the economic performance of companies will come. The country will come. So we will not actually give due weightage to all these information. If you are planning to take a decision, make investment decision, you at present, and you want to sell it off in April or in May, you will estimate the Sensex on the basis of current level, without considering the happenings in future or in near future. That kind of a bias is technically the anchoring and adjustment bias. Okay. Generally, investors become anchored on the economic states of certain countries or on the basis of some companies. So, for example, for making a general opinion regarding or general estimation regarding regarding some companies for making investment, or general opinion regarding the capital market as a whole, a person having anchoring and adjustment bias or faced with anchoring and adjustment bias definitely look into the performance of a particular economy or look into the performance of a particular company and make judgments regarding the uh, performance of the whole financial market or the capital market. Now, I would like to tell you one more. Only the last one I have marked so many things, but there is for sake of time, I would like to tell you only one more bias. Definitely, I will speak to you in detail about more number of bias. Actually, my dear friends, for teaching all these bias, we need a lot of time. By taking 1 hour, we may be able to speak in detail about overconfidence bias or cognitive dissonance bias and so on. So, the last one is cognitive dissonance. This is actually a cognitive bias. Actually, this bias says a newly acquired information actually uh, conflicts with the pre-existing understandings. People often experience mental discomfort. Once again, I would like to tell you, when you have a new piece of information, when you have some new piece of information regarding particular thing, which actually conflict your pre-existing understanding about that, you may feel a mental discomfort. You may feel a mental discomfort. Say, for example, suppose if you have purchased an electric motor car very recently, imagine, by spending around 17 lakhs, you purchase an electric motor car. As far as electric motor car is concerned, the capacity or the evaluation is basically on the number of kilometers that can be traveled in single charging. Say Tata says their car will run for more than 400 kilometers in a single charging. Other companies have different arguments. Say imagine you have purchased one which can travel 350 kilometers on an average in a single charging. You have experienced it. You are satisfied with that. At that time, a new news comes. Tesla comes to India. Suppose if Tesla says our new car can travel 700 kilometers in a single charge, this is only imaginary. Tesla demands, if Tesla demands that our car can travel 700 kilometers in a single charge. What will be your feeling? Suppose if the price level is almost similar, other features are also similar. You imagine that you got a new piece of information, you will be disappointed. You feel a mental discomfort because you may feel that the decision taken by you was actually wrong. That is what is known as cognitive dissonance bias. My dear friends, a student of mine is doing a PhD in this topic. It's a wonderful topic. Due to positive time, I'm not able to speak in detail about these biases. Again, definitely I will come up in other venues so that I will be able to discuss in detail each and every bias. So I'm so thankful to all the listeners. I'm thankful to the organizers. I'm thankful to the faculty members in my department who motivated me to uh, engage in these ventures. So thank you so much for listening to me. Over to Joshi.
Hello,
Yeah,
thank you,
thank
sir.
you so much, sir.
Hello.
Today, in fact, we really had an intellectual treat on with a very great, like with a great introduction onto the topic behavioral finance. And as we all know, Dr. Antony Joseph sir is an excellent teacher with 27 years of teaching experience, and moreover, a teacher with great passion in research. He's also an eminent research guide in Mahatma Gandhi University for the past 7 years. And above all, a true academician. And sir, today you have proved it all again that you are an excellent teacher, a great researcher, and moreover, a true academician. Thank you so much for being the resource person for today. And now it is the time for intellectual deliberation. And dear participants, you can raise your questions in the chat box, or you can kindly unmute your mic and raise your questions. I think we have some questions in the chat box. So we have a question from Shisa Nidant. The question is that how far behavioral finance could be used as an index to explain the irrational behavior of investors? Is there a real model universally followed?
Once again, please. Okay.
Sir, is the question clear?
No, please once again.
Yes, sir. How far behavioral finance could be used as an index to explain the irrational behavior of investors? Is there a real model universally followed?
Actually, behavioral finance cannot act as an index. Behavioral finance actually explains how the behavior of people, the cognitive errors of people, the emotional specialities, as well as the personality characteristics of people influence their decisions, especially the investment decisions. Actually, the behavioral finance is dealing with investment as well as other aspects also, like credit behavior, savings behavior, and so on. So, investment behavior in behavioral finance can explain uh, the uh, the uh, the problems that are actually faced by people, the outcomes of different biases, and how to overcome these from these biases. These are actually done by the behavioral finance. We can't construct an index out of that. It is not possible. But there are some beautiful models in this. Definitely, if you guys give an opportunity, I will definitely speak to you about wonderful models in behavioral finance. So many models are there. Okay.
So we have another question. What is the impact of anchoring on investment decisions? By Priyan Shah.
Okay. Uh, when a particular investor is faced with the problem of anchoring and adjustment bias, definitely uh, the estimation regarding future will be based on the point where he anchored or the base point. Say for example, if actually a particular investor is faced with the problem of anchoring and he want to take an investment decision, uh, he is actually going for an investment of rupees 1 lakh. Definitely he is expected to make an estimation regarding the future time, the price of that particular security in future. Suppose if the price of that particular share is rupees 625, definitely the estimation of the price of that particular security after 1 year may be based on the current price. He definitely will expect 10% or 20% according to his estimation up from the current level. So naturally, the question is, what is the logic behind taking current level as the base? Taking current level or taking a particular level as a base is itself is a mistake. That is not scientific. So the investor most probably will incur some losses while faced with anchoring and adjustment bias. That's the issue.
Sir, again, we have a question by Shita, that it is the herd behavior that drives most of the first stage investors towards investment. How is it then behavioral finance different from neuroeconomics, as the essence of the same is explained under both?
Okay, very good question. Herding is actually very prevalent in case of new investors. Not only in case of new investors, there are a large number of investors showing herd behavior. That is, when some experts are saying this is a good share, or when a famous investor is investing in a particular share, definitely the investors having knowledge about that will choose similar shares. So naturally, the people will end up with losses in future because persons having technical information regarding such shares may liquidate such securities whenever they find that there is danger in that. But these people having herd behavior may not find the time at which the original investor liquidate his holdings. So there is a possibility of committing losses by that way. And at the same time, there are some goals for making decisions. Even the original investor, whose pattern is being followed by some others, the goal of that investor may not be different from that of the other investor. So herding can influence, especially in case of new investors. New investors will observe what are the shares which are actually moving fast. Moving fast, shares which are moving fast are actually demanded by many people. So naturally, I am also following that. That is the kind of behavior, herding behavior. Definitely, it's people should be very careful. Some people are actually making gains out of it, but should be very careful. And neuroeconomics, my dear friends, there are so many terms which are very close to behavioral finance. The fundamental or the very basic of these behavioral finance, neuroeconomics, and so on are the behavioral economics. Behavioral economics is the engine that give energy to the researchers in conducting experimental research in behavioral finance. Actually, these are very closely related.
So we have one final question.
Okay.
The question is from Tushar.
Hmm.
Today we have ventured to new areas of neurofinance and experimental finance. Please explain the types of experiments that can be conducted in Indian context for publishing in Scopus journals?
Okay, it's a very good question, but at the same time, uh, you first of all remember the types of research. Before understanding exactly what are the different types of researches which can be conducted by people like us, we have to have some sort of understanding, very good understanding about the psychological research. In economics, a large number of studies are conducted on experimental basis. In finance also, a large number of studies are conducted, uh, experimental studies are conducted. We have to see there is no speciality with respect to Indian context. Wherever the experiments can be conducted, but the question is what facility we have. We need behavioral finance labs for conducting experiments. That's very important, very important. There are very few universities and colleges having behavioral finance labs. To the best of my knowledge, we have behavioral finance labs in some Indian Institute of Management and in Delhi University. Some other labs dealing with some other economics institutions also having behavioral economics labs. And I humbly suggest the person who raised this question to read a book which actually very brilliantly explaining different kinds of experimental research. The book written by Dan Ariely, Ariely, Dan Ariely. Name of the book is The Upside of Irrationality. The Upside of Irrationality. The book is with me now. The book is with me. The Upside of Irrationality. This book is considered to be is found to be the simplest one I have ever read. I have the book written by almost all famous authors, but it is very difficult for understanding many books. Say for example, the book written by Daniel Kahneman, Thinking Fast and Slow. I have purchased this 2 years or 3 years back. I'm not able to complete this even now because reading at a stretch more than 3-4 pages of this book is practically impossible for me because it is so tough. So, but the upside of irrationality, you buy one, read it. It's highly very much interesting. Explained the different types of experiments he has conducted in a very beautiful language, simple language everyone can understand. Thank you so much.
Thank you so much, sir. We really had a great intellectual deliberation. Thank you so much. Now, for the attention of the participants, kindly fill in the feedback form which has been given in the chat box so that you can ensure your certificate of participation. And the certificates will be received at your end within 1 week time. And dear participants, it is your genuine interest, active participation, and valuable response which turned out this session to a successful one. And we also apologize for the fact that, in fact, we had more than 400 registrants for our session, but unfortunately, we could only admit around 200 participants. So we really apologize for the same. And now let me invite my dear friend and colleague, Ms. Josni Jose, who is the faculty coordinator of the session for the vote of thanks.
Thank you, Steffi Miss. Honorable Chief Guest, Dr. Antony Joseph K., respected HOD, Dr. Joshi Andrews, and dear participants. I know I'm standing between you and the lunch time, but still, on behalf of Research and Postgraduate Department of Commerce, St. Aloysius College, Edathua, and its entire fraternity and the organizing committee, I feel immense pleasure to take this opportunity to propose vote of thanks to our chief guest, Dr. Antony Joseph K., Associate Professor, Department of Commerce, SP College, Chagnasheri. As we are already mentioned, he is a true academician, an excellent teacher, and a wonderful research guide who spared time from his busy schedule to grace this webinar with his extremely relevant address on an introduction to behavioral finance. He rightly talked about a very interesting arena of study wherein the behavioral pattern of the investees can be very easily traced out. He had made 100% justice to the title of this section by narrating the influence of psychology on the financial decision making, various theories, many contributions in this area in a very simple manner, I'm sure, which is definitely going to help both TJs and PG students who are going to deal with the same topic in the coming fourth semester. Don't forget his suggestion regarding reading more and more about the same, which will ultimately make you an expert in this area. Okay, sir, you're very kind enough to offer your collections in this area to the participants. Thank you so much, sir. I would further extend a hearty thanks to Dr. Joshi Andrews, HOD, Research and Postgraduate Department of Commerce, St. Aloysius College, Edathua, the man behind all our new initiatives, young and vibrant personality. We are very grateful for his unfaltering support and confidence in us. Thank you, sir. I take this opportunity to specially express my deep regards and gratitude to the principal, the management of St. Aloysius College, Edathua, for encouraging us and providing opportunities to organize these kind of events. My deep sense of appreciation and thanks to all the participants who chose to be live with us and attended this webinar with great enthusiasm and make it a meaningful event. My sincere gratitude also goes to my colleagues and friends, Professor Praveen Joseph, Professor Steffi K. Joss, Professor Manoj Sevier, Professor Tony Thomas, and Professor Lipson Lonapan, who really stood by me and helped me in this effort through this entire program from the very beginning till now. I couldn't have pulled any of this together without their support, and I'm very, very grateful. Now, I would love to especially mention a name, Miss Archana, the student coordinator, her entire team, consisting of our second PG students, who really put an effort to bring you all here. Thank you, dears. Once again, I thank you all for being with us this afternoon. Have a wonderful day ahead. Thank you. Thank you all.
Thank you, sir.
Thank you, Yoshi. ഞാൻ വിളിക്കാം ജോഷി.
Yes. Okay, sir. Thank you very much. എനിക്കൊന്ന് ആങ്കറിനെ കിട്ടുന്നില്ല, കണക്ഷൻ കിട്ടുന്നില്ലെന്ന് തോന്നുന്നു. He's actually has to wind up the session.
Yes, thank you. Thank you all once again. Thank you so much, Anthony, sir.
Okay, thank you.
Really intellectual treat for us. Thank you so much. And the man behind this great initiative, our beloved HOD, Dr. Joshi Andrew, sir, is in fact our great leader with a wide vision. So let me extend our wholehearted thanks to our HOD as well. Thank you so much, dear participants as well. Thank you all.
Thank you. Thank you, sir. Thank you very much.
Thank you, sir.
Thank you, sir.